Good afternoon, everybody, and thank you for joining us today. My name is Lori Drake, and I am the Building Blocks Community Manager here at Handle. For those that aren't familiar with Handle, we have a platform that is purposely built for building materials suppliers within the sector of construction, focusing on lien rights management, waiver compliance, and payments with a new dedicated payment portal that accommodates a range of methods from ACH to credit cards. And today we are joined by Jenna Wheeler and Dan North with Allianz Trade. Thank you for joining us today.
Sure.
Thanks for having us.
Happy to be here.
Jenna, do you want to go ahead and introduce yourself and then introduce Dan, and we'll go from there?
Sure, absolutely. Thanks, Lori. I appreciate it, and definitely appreciate the opportunity. And I'm Jenna Wheeler. I'm with Allianz Trade, and I am going to talk a little bit about trade credit insurance here in a bit. But first, I want to just take a moment to introduce Dan North to you. Have the pleasure of having him here to talk with us today. And he's been with us for many years, since about 1996, I believe, and is our chief economist in North America. He has been featured on media outlets all over the world. CNN's, New York Times, BBC. He's been a commentator in so many places, and he provides macroeconomic insights across trade shows and events all over the country. So happy to have him here to be the subject matter expert for you and speak a little bit about what we can expect from the economy here in 2024. So Dan, I'm going to hand it over to you, and look forward to hearing what you have to say.
Okay, thank you very much, Jenna, and thank you very much to Lori for that kind introduction, and thanks to Handle for having me. I am going to speak for around a half an hour on the U.S. economy, and then we're going to go to Jenna. Jenna, she's got a little bit of talk on our product, what our company does, trade credit insurance, and then we'll go to Q&A. So let's see here. There we go. So yes, I'm going to give an outlook for the U.S. economy. But before I get started, I just want to tell you just a second about who we are, because not necessarily a lot of people have heard about us. We are the leader, the global leader in trade credit insurance. And basically the way it works is if our clients sell goods and services on open account to other businesses, they hope to get paid back in 30 or 60 or 90 days, but they run the risk that business they sold to will go insolvent in that time period, or just not pay them back. We insure our clients against that, against non-payment. We're in 52 countries around the world. We've been around for over 100 years. We have 5,500 employees and 62,000 clients, and there's lots of other numbers on this slide, but the one I think is most important, or one of them, is this one down in the lower left. 1,000 claims indemnified each week. Trade credit insurance is a discretionary purchase. It's not like auto insurance where you have to buy it to drive. It's discretionary, so we have to add value for our clients. And the way we do that is paying claims. Every CEO I've ever had in this company has always said we need to pay more claims. It's counterintuitive for an insurance company, but that's what we do. We cover our clients against non-payment. So we have to have a good idea as to the degree of non-payment or bankruptcy risk that there is in the economy. So part of my job is to look at the macro economy. And right now, there's some really pretty big positives. And I'll go through these because I'm going to spend a bit more time on the negatives and what can go wrong looking into the next year. But right now, we've got some pretty good stuff. Consumers, 70% of the economy are still spending, and they have been spending. That's the chart on the left, personal consumption expenditures. The columns are the month-to-month growth in spending. So you can see a little bit more about what's happening recently. And then the line is the year-over-year growth rate. It gives you kind of a longer-term trend. You can see that's growing at 2.7%. That's okay. It's not as high as the long-term average of 3.3%, but it's okay. Now, one of the reasons that consumers can spend is that they have income. This is the chart on the right. So the columns again, the month-to-month growth rates, and the black line is the year-over-year growth rate, which is pretty strong right now at 4.3%. But if you look down here, you can see a number of months in here where growth was flat and negative. And I think there's going to be more decay in income, which will really make it harder for the consumer. One thing I'll point out is this giant column here in last January, where there was a huge bump in Social Security adjustments. We're not going to get that this year. So that black line is going to go down. So income is going to erode. But right now, let's say consumers, 70% of the economy, are doing really well. Here are a couple of other things. The labor market is doing very well. The chart on the left shows what I call the headline numbers of the labor market. That black line is the unemployment rate. And you can see that's pretty low. It's near an historic low. It is important, however, to understand what that is. You see, in this calculation, the government counts you as unemployed if you don't have a job, but you're looking for one. If you're unemployed, but you're not looking for a job, you're not counted as unemployed, you're counted as not participating. So the point of that number is it doesn't take into account at all the 140 million people or so that are still at home not working. It's a good number to have, that unemployment that low. It's a good measure of the labor market, but you have to know what it means. The other number we see there is those blue columns. That's the number of jobs grown every month. And you can see there's this blue column here in 2020. That was when we lost 22 million jobs because of the COVID shutdown. Well, ever since then, we have been growing jobs over here at the rate of about 400,000 a month. That compares to 200,000 a month beforehand. It's important to note, what I really should have said is we've been recovering jobs, because what happened is in March and April of 2020, suppose that your non-essential business shut down and you weren't employed for that month. Well, that looked like a job loss. But then the business the next month opened up and that was a job gain. Well, the job was never gone. It was just closed for a month. So all this area in here is recovery from this giant column of losses here that goes down to 22 million. Everything but 20% of the jobs here are created. Most of them are recovered. Let's say we're happy about this, that the economy is able to recover those jobs and the unemployment rate is low, but also understand what it is. Services sector, which is 80% of the economy, that's the chart on the right, is doing very well. This is a measure called the ISM survey. It's been around since World War II. It's carefully watched by economists. And basically, it means if it's above 50, it means expansion. There are 10 parts to this survey, but the black line is the total survey at 52.7, well above the 50 range, into expansion. And then there's part of the survey called new orders. That kind of gives you an idea of its work in the pipeline that will provide employment and economic activity coming over the next few months. That's well into expansionary territory as well. So 80% of the economy, services are doing well. The labor market is able to recover jobs, and the consumer is spending. Those are pretty big positives. They really are. And that's what's keeping us going. However, there are some negatives as well, which I think are important to look at, because I think it's going to have a big influence on what's coming up next year. And the negatives are inflation, but not so much inflation, the Fed's cure for inflation. and how that has damaged the economy and will continue to damage the economy and housing, manufacturing, freight, and the labor market. Now, it's the Fed's job to crush inflation, and the way it does that is by raising interest rates. The Fed's favorite measure of inflation is this chart on the left: personal consumption expenditures price growth. And that's at 3.2% year over year. Now, that's not the target of 2%, but you can look at this data in a little shorter time period, like the chart in the middle, that bright blue line over the last 3 months. Inflation's been running at an annual rate of 2.2%. And you can go even further over on the right. You can see the 6-month rate of inflation at 1.9%. So what those numbers tell you is there is some acceleration in the slowdown of overall inflation by this measure. And this is good. We'll actually get an update on this measure on Thursday and Friday, and we expect it to keep creeping down a little bit more. This is the Fed's favorite measure, PCE core. Most people look at a different measure called the Consumer Price Index, the CPI, the headline CPI, and that's this chart over on the left. By the way, the difference between this one and this one, if you want me to bore you to tears, I can do that. But there are some differences, but this is the headline that most people look at. And you can see it peaked at 9.1% in June of 2022. That was a 40-year high, 40 years. That was really, really high. But ever since then, the inflation rate has come down to 3.2%. And that's good, isn't it? It is good. But remember that it was peaked at 9.1%, and then it was 8%, and then it was 7%, and 7.5%, and 6%. The point is, inflation is cumulative. And just because this line is going down doesn't mean prices are going down. Prices are still growing. Inflation is still here, but it's at 3.2%, not at 9%. As I mentioned before, prices, we've had to live through high inflation for several years. It becomes cumulative. And if we look at the chart on the right, starting in January of 2021, this black line here, this is wage earners. Well, wages over that time period have grown 14%. But the things that wage earners need to live have grown much faster, like food's up 20%, and housing's up 30%, and gasoline's up 37%. This is why things still feel expensive, because they are, and the inflation is still with us. Wage earners are still underwater compared to a couple of years ago. So this is harm to the economy. This is big harm. This is one of the reasons why the Federal Reserve has had to be so aggressive in hiking rates to quell inflation, because of this really an almost dramatic societal problem of wage earners being underwater. So the Fed has been very aggressive. That's the chart there on the left. Now, each of these lines is a different Fed hiking cycle where they started to hike the Fed funds interest rate. And by the way, a lot of people say, oh, the Fed's raising interest rates. And I say it too, but really the Fed only controls one interest rate. That's the overnight Fed funds rate. And that's what these lines are. And each one is a different hiking cycle. You don't have to look at the dates of them all. All you have to do is look at the red line, which is 2022 to 23, and you can see how much more aggressive it is compared to previous instances. Now, the Fed's been very aggressive, and the question is, maybe has it been too aggressive? And I think that's possible. And here's what I mean. If we look at this chart over on the right, it shows the fact that it takes 3 to 5 quarters for monetary policy changes to have full effect on inflation and the economy. It takes time. So the first interest rate hike was in March of 2022. That's what these arrows are. And that was, almost 2 years ago. So you could say that hike has gone all the way through the economy and had its full effect. Same thing with May of 22 and June and July even of 22, September of 22. All those have had their time, 3 to 5 quarters, sometimes 6, to have full effect on the economy. Well, how about the one in December 2022? Well, it's had most of its effect, but maybe not all of it. And not the ones in January of 23 or March or May or July. They haven't had their full effect yet. And that's why we think there's still going to be a slowdown coming. It takes time for monetary policy actions to work. In the meantime, they have worked in several sectors. The first victim was housing. Now, the chart on the left shows this vertical dotted line. That's when the Federal Reserve, that had been saying back in 2021, oh, inflation's transitory, don't worry about it. And that went on for a whole year. And finally, by the end of the year, they said, well, I guess inflation actually isn't transitory after all, which sent a signal to financial markets that interest rates were going to go up. That's that black line. That's the 30-year mortgage went from 3% up to above 7%. That's that financial markets driving up interest rates because the Fed was going to. So over that same time period, as the mortgage rose, existing home sales, the blue line, fell 37%. Pretty direct correlation between the Fed raising rates, the mortgage rate going up, and a drop off in sales. Just about every other measure in the housing market shows the same thing. Starts, prices, new home sales, just about every other measure. All right, so that's activity in the housing market. Let's look at prices. Now, this goes back to the pre-COVID era. And this is an index. These aren't actual dollar amounts, but you can figure out the percentages. And you can see over the couple of years before 2020, things were moving along. But then COVID hit and prices soared because people wanted to buy houses that were out of the city. And you know the story, prices rose dramatically. Then they took a dip, but they're still 50% higher than pre-COVID prices. Still 50% higher. So you combine that very high interest rate and very high housing prices, the affordability of houses, which is that line over in the right-hand chart, is near a 40-year low. The further down that chart goes, the less affordable houses are. And now with this very high mortgage rate and very high prices, near a 40-year low, that's going to be difficult to overcome. So, this to a certain extent shows what's happened, but the result is that the affordability is very far down, and that's going to continue for a while. So housing was the first victim. Next victim was manufacturing. Manufacturing is interest rate sensitive. Companies that want to buy equipment have to borrow money to finance it. So interest rates go up. There's less equipment being manufactured. And we can see that here in a couple different measures. So this dark blue line, that's new orders for durable goods. These are big pieces of equipment, like, there's consumer equipment like appliances, but there's also cars and airplanes and so forth. And you can see the growth rate has dropped off very dramatically. That blue line, industrial production, well, that's just a measure of everything that comes out of the gate of the factory. And you can see that's actually shrinking now. There in the text, this industrial production index is divided into something like 65 sub-indexes, and 2/3 of them are negative. Now, the chart on the right shows another measure of manufacturing. We go back to this ISM index, where if it's below 50, it means it's in contraction. Well, that blue line there, 47.4, that's the total. That's below 50, showing manufacturing is in contraction. And new orders, giving us an idea of what's coming down the pipeline, same thing. So you've got 1, 2, 3, 4, 5 measurements of manufacturing there, and they're all saying contraction. And so I would argue that, manufacturing is in a period of recession as well. Now, when goods are manufactured, how do they get to you? They get to you by freight. If you look around the room where you're sitting, desks, chairs, food, water, everything there, it all comes by freight, and most of it comes by truck at the last few miles. So trucking has been suffering as well. Here's several measures. There's over on the left is a measure of trucking expenditures. It's down 28% since the Fed started raising interest rates. And I spoke with some trucking companies recently at a conference, and they all said, trucking is a disaster right now. So freight definitely in a recession. And over on the right is shipping containers. That's down 16.5%. This does not include the effects of what's going on in the Middle East. I don't know what's going to go on and how this is going to be measured, but if these are import containers coming into our harbors, it's almost certainly going to slow down because it's going to be a much longer transit period. But point is, freight's in contraction as well. Now, I'm going to look at the labor market for a minute. Remember I told you right at the beginning that we have a low unemployment rate and lots of job growth, and those headline numbers look good. The headline numbers do look good. But if you look underneath, there's some decay happening, like this chart over on the left. This is the year-over-year job growth rate of job creation. Clearly peaked in February of 2022 and now has come down to 1.8%. This is a typical pattern you see when you approach a slowdown in the economy. Job growth rates start to shrink. Over on the right are a couple of other measures. That dark line, that's job quits. This is when, just after COVID, people are like, I know the labor market's great. I can quit my job and get another one in a heartbeat. So that's why it was up so high. Well, now people aren't quite feeling that way. They're back down to pre-COVID levels. The blue line is openings. There used to be a huge number of openings after COVID, and that's dropped off to minus 13% year over year. Here are a couple of other measures. Here's temporary employment, that blue line. Whenever you have a shrinkage in temporary employment, it's followed by those gray columns, which are recessions. And I'm going to use the term slowdown because that's what we're expecting. And this makes sense because temps are the first ones to go. And another measure is this chart on the right from the Consumer Confidence Survey. This is a phone survey where they'll call up people and say, are jobs plentiful or are they hard to get? And people have been saying mostly up until recently, jobs have been plentiful and not so hard to get. But now they're starting to change their tune a little bit. Jobs are less plentiful and they're a bit harder to get. Now, when times are good, this blue line goes up. People are saying jobs are plentiful, not hard to get. But when it peaks and people start saying the opposite, they start saying, jobs aren't as plentiful and they're getting harder to get. When that turns, the economy is getting a little bit worse, and it's always followed by one of those gray columns, a recession. So you can see, I think there are a number of measures here in the labor market. And here's the last one. This is jobless claims. This is a case where, let's say you worked for a company and, where you worked, the building burned down or went out of business, or you just got fired. That's when you go to the local unemployment office and say, I'm out of work, I need my unemployment benefits. That's what the blue line is. It's the number of people that go to the unemployment office every week. When times are good, fewer and fewer people are filing for unemployment benefits. They don't have to. But when times are bad, more and more people have to file for unemployment benefits, and the line goes up. When things change from good to bad, that is when this blue line bottoms out, it's been followed by a recession. And this is over a 50-year chart. Every time that blue line bottoms out, here, here, and bottoming out last September, followed by a slowdown. Okay, so I have this argument in the labor market, I think, that underneath these shiny headlines, there is decay and that there is a slowdown coming, but I still get pushback. People are saying, what are you talking about? A slowdown coming? How can that be? We just grew 200,000 jobs last month or whatever. I don't understand what you're talking about. Labor market's strong. My response is, that's the way it works. Labor is the last pillar of the economy to fall because no employer wants to fire anybody unless they really have to. And the chart on the right shows that. Now, each of these lines is a different recession. You don't have to look at this key. Each of these lines is a different recession. And it starts 12 months before the recession. 0 is that vertical dotted line when the recession starts, and then it goes out another 12 months. And the lines are plotted against the number of jobs created. The point of the chart is 12, 6, 10, 6, 8 months, even 1 month before the recession starts, the economy is still growing jobs at a strong rate. They're all growing jobs here in this green box, all positive growth. And then once the recession starts, that's when you get the job loss. It happens very, very quickly. The fact that you got a strong job report last month tells you nothing about what's going to happen next month. It falls off very, very rapidly. So we still see a slowdown coming. Now, let me look back a little bit. I showed you this chart, which is what I call leading indicator. When it goes down to here, it gives you a lead in time about what's going to happen next. And here were a couple of others, same thing, led the economy. One of my favorites, one of economists' lots of favorites, is the Treasury yield curve. That's the blue line on the left. It's just the difference between 10-year interest rates and 3-month interest rates, or conceptually long-term rates versus short-term rates. So for instance, here, let's say the blue line is plotted at 200 basis points. That might be the case where you have the 10-year at 3% and the 3-month at 1%, and the gap is 2% or 200 basis points. Now you can see that blue line is almost always positive, which makes sense. If you're going to lend money for 10 years instead of 3 months, you'll demand a higher interest rate. That's why that blue line is almost always positive, except for times like this, when the Federal Reserve starts jacking up short-term interest rates to the point they become higher than long-term rates. And that gap goes negative. That blue line goes negative. The difference becomes negative. And every time it does, it's been followed a recession. This goes back again to before 1970, a long way. And you can see it gives us a lead here as well. When it goes negative, there's the recession here, 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 here. And we just recently set a record low. Again, the length of the red arrows is important. That's the amount of lead it tells you. It gives you a warning of something like 3 to 5 quarters, maybe 6 quarters. Another one, this chart on the left is, I think, is a good one because it basically is driven by interest rates set by the financial markets, which tend to be pretty rational on the bond market side. And it's basically when that blue line goes negative and the yield curve goes negative, it's the bond market saying, Federal Reserve, you've already gone too far. Consumers are also saying Fed has gone too far. This is back to the consumer confidence survey. They're calling people and saying, how do you feel about things now? Well, pretty good. How about things in the future? Oh boy, I don't like the way things are looking in the future. When you get that big a divergence in those answers, that blue line goes down, meaning people are much more concerned about the future. It's almost always followed by a downturn here, 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 here. And we just hit the 56-year low here. Basically, it's consumers when they're concerned about the future, they're right. Okay, so I think we've got these leading indicators, and we've started talking about a slowdown last year, and I'm seeing lots of articles saying, okay, you smart economists, why isn't it here yet? Why don't we have a slowdown? Well, there's several reasons that are a bit different than other recessions. First, again, it takes time for all of those interest rate hikes to have their full effect. This is the chart we saw a while ago. And not all of those rates have had the full effect. And while the Federal Reserve is trying to tighten up monetary conditions and tighten up liquidity and slow the economy down, the administration and Congress has been doing exactly the opposite. The chart on the right is budget outlays. You can see after COVID, budget outlays from the federal government were greatly increased, and they're never going to go back down, basically. So the Fed's trying to slow the economy, and Congress is trying to speed the economy up. So that's been one reason. Another reason is over here on the left. This is blue line is corporate net interest payments at a record low. What happened was the Fed sent rates to zero and left them there too long, which is a very dangerous thing to do. Corporations locked in debt at a very low rate. So here are these net interest rate payments at a record low. They're kind of saying, Federal Reserve, go ahead, raise the rates. We don't care. We locked in. Same thing with consumers over on the right. This blue line is the financial obligations ratio. It's really, debt service ratio. It's really just mortgage and consumer debt as a percentage of income. You can see that it was very, very low, and it's the same thing. Mortgage debt's very, very low relative to income. So they locked in low mortgages, but it hasn't had that big effect yet. Now, let's go and look at what's happening next. And to do that, we'll look at the consumer. And the consumer outlook is not great. So we looked at this chart before. This is consumer income. As I mentioned, we had a couple of months there of flat or negative growth. And I also mentioned that this number is going to drop off sharply because we're not going to get that Social Security increase we got last year. So if you need to spend money, consumers need to keep going. What are you going to do if income's going to drop off? Well, one place you can get money is savings. That's the chart on the right. But savings are drying up as well. All right, you don't have income, you don't have savings. Now where are you going to go? Well, you go to credit cards, of course. That's the chart on the left. That's the amount of credit card debt outstanding, up 37% in 3 years. The big trouble is it's rising at really outrageous interest rates. That's the chart in the middle. The average rate is 21%. If you have a low credit score, it's even worse. And as a result of all this credit card debt at very high rates, we're starting to get credit card delinquencies rising. So that's what the headwinds are that are facing the consumer that we think is going to contribute to a slowdown. Finally, it's important to look back at the historical record of what the Federal Reserve does. The Federal Reserve always waits too long, and it always raises rates until something breaks. We look at the chart on the left. This is the past 30 years. That red line's the Fed funds rate. Here they kept raising the rates until we got the savings and loan crisis. And then we raised rates to the tequila crisis, and then the dot-com bust, and then the global financial crisis, and the repo crisis. And the chart in the middle is the same thing over the last 100 years. For us, what has broken is the chart on the right, is the number of insolvencies, bankruptcies. This is the nationwide bankruptcy filings. And you can see this goes back to the 80s. Over the last 40 years, it's steadily fallen. The only other thing that's steadily fallen is long-term rates until now, and then they went up sharply, and so has insolvencies. And our forecast is that red insolvencies are going to go up even more. Again, a huge percentage increase only brings us back to still low levels, and we're well positioned to manage. All right, let me wrap up here. As I mentioned, the economy has signs of strength, consumption, labor market, services sector, but inflation is still killing wage earners. These sectors are still hurting and their outlooks aren't great. And it's because the Fed started so far behind. And the signs suggest that we will have slowdown in 2024. Thank you very much. Now, at this point, I am going to hand it over to Jenna, who will walk through some, I think, interesting information on trade credit insurance.
Thanks, Dan. Appreciate all your insight. And definitely what I want to do is just kind of touch real quickly on trade credit insurance. I introduced myself before, but I'm Jenna Wheeler. I'm with Allianz, and I work as a trade risk consultant. I'm here in Ohio, but we are in all 50 states. And as Dan told you before, we are a global company. In fact, we're kind of the Goliath. Well, not kind of, but that's what we do. Who we are and what we do. So I want to go into just a few things about what exactly we handle and what we protect. We protect from insolvency, obviously the Chapter 7, 11, and 13 bulk sales receiverships. And when we talk about Chapter 11, I think it's important to note that one of the reasons why it's important to learn more about trade credit insurance right now, if you're not familiar with it, is those Chapter 11 commercial filings increased in 2023. They're up 72% year over year from the year before. That number is not expected to slow in 2024. So it's definitely the right time to be learning about your options if it's not something that you've looked at before. Slow payment is something else that we protect against, and slow payment is actually it's the number one source of claims for us, and I think that's usually comes as a surprise to people. But essentially, we act like the collection company with a guarantee. Cash flow is important, and when late payments and slow payments start to affect the cash flow, that can affect the business. And so that is one of the reasons why people will use trade credit insurance. And then political and export risks coverage, you can protect export business, you can protect your domestic business, but both of those are reasons why people will choose to use trade credit insurance. So if we go to the next slide, the big reason why it's important to consider covering your receivables is, a lot of people don't think that they need to do it, but honestly, most everything else in the business is insured. Your assets sometimes can be 40%, sometimes 80% represented by your accounts receivable. So it's a huge chunk of your assets, but a lot of times it's the only piece that's not insured. You'll have your land, your buildings, equipment, and cash. All of those will be covered by an insurance, but a lot of times the receivables is not. So that's where we can step in and provide that protection. If we jump onto the next page, the strength of our data is where we really stand out as a company. Allianz, again, we're number one. So if there's $3 trillion protected by trade credit insurance in the global economy, 1 trillion of that is protected by Allianz. We're covering 1 trillion of that. And then in the US, we make up 40% of that. So a third of the market share globally and 40% here in the US. We're monitoring 85 million companies. in our risk database. We are active in over 92% of the global GDP with those markets, and have proprietary third-party data sources. We have data scientists on hand. We have predictive analytics and modeling. And I think the big thing to point out is that because we have our hands on so many different markets and over so many different sectors, one of the things that is unique to the data that we're able to provide is we have this 55,000 commercial clients reporting past due payments to us. What that means is we can essentially see into the future. It's how we connect the dots for our clients. So we're able to kind of say, here's where we see some concern. It may not be the person that you're doing business with. It may be somebody that's doing business with them and is doing business with them. And then we see the problem and we're able to connect those dots. So that's one of the reasons why, and the biggest reason why our data strength is so important. We're really a data company more so than an insurance company. If you think of traditional insurance, we are a property and casualty product, but we're really like a front end risk management partnership, and the data is the real source of our strength. So if we go to the next slide, there's 4 main reasons why people will partner with a trade credit insurer. Obviously, number one, the catastrophic loss and the cash flow protection, right? So you want to protect those things and keep your business flowing regardless of what happens with the economy and all the challenges that we're seeing that Dan brought up. So that catastrophic loss and cash flow protection, those are obviously key reasons. But one of the biggest reasons why people will use us is safe expansion of their sales. So because we have this additional data, because we are able to guarantee payment, it allows companies to expand quicker and into new markets, make what they might consider a riskier decision from a credit standpoint because they have our guarantee backing them up. We optimize credit functions, so we're able to act as a supporting arm to a credit management process. I work with controllers, I work with credit analysts, and they'll reach out for additional information. We help provide some structure, some discipline for their credit decision making. So maybe there's not a process in place. Maybe we can help to structure that. Or maybe we just, myself and the team that I work with at Allianz, we act as additional arms to that credit process. So there's different ways, but that credit function piece is where we kind of, just supercharge the strength of the credit process. And then the bank financing is one that a lot of people don't even realize. So by having what's AA paper, basically, but Standard & Poor has, we have a AA rating, which is better than the banks right now. We are enhancing your receivables and guaranteeing that. So if you're going out for an asset-based loan, then you're more likely to get either better terms or be able to borrow additional dollars on those receivables. So if we bump to the next slide, I think that's the last one I have. And it just, if you have questions and you would like to know more about a partnership with Allianz, one of the first things that we do is we get together, we have a risk analysis, and that involves me sitting down with you, either one-on-one, we can have a conversation on the phone, we can do a Zoom meeting, but I gather some basic company info, we get the sales loss history, some buyer data, and then we talk about your goals. Is it the sales expansion that you're looking to do? Are you looking for an opportunity to, get better financing with your bank? Are you wanting to improve your credit function or support your credit manager or support your controller? What is it that you're looking to achieve? Those are the things that we're going to sit down and talk about up front. Then I'll gather some data and I will go in and scrub our database, get some information about the buyers that you want to take a look at. And I'll sit down with underwriting. We talk about your goals and we put together a policy structure. It's going to be based on whatever it is that you want to achieve. So we do that risk analysis, put proposal together, and then we will sit down and go through those things together. I'll go over what kind of risk we see. So it's going to be, kind of enlightening. A lot of times people will find that maybe we can expand the risk you're taking on with one of your customers. Maybe you're, right now doing 50,000 in extended credit, and maybe we would be happy to do 150,000 as far as what we'll cover and insure. So we look for opportunities, things like that. We'll sit down in that proposal and we'll do that review and show what kind of opportunities are there. And then the fourth step is the implementation. And so that's just basically selecting when you want to get a partnership started, if that makes sense for you. And then at that point, we get you introduced to the rest of my team that I work with, and the sales expansion and credit enhancement kind of begins for you. So that's really it. I don't want to take a lot more time because I know we've gone, longer than maybe we were intending, but definitely want to bounce it back to Lori and see if anybody has any questions for myself or for Dan. But I want to invite anybody that would like to have a discussion. Please reach out to me. I'd love to share some risk data with you. And there's no harm in asking for that information. I'm happy to share it and have that discussion and, take those steps.
Well, thank you, Dan and Jenna. Hearing the changes throughout each year is surprising to see how things actually repeat themselves. I don't think people are aware of that a lot of times. So it's definitely great information, a lot of information. So I appreciate how clear you made that for everybody. We do have a couple of questions that came up. Jenna, this one's for you. On your process standpoint that you were just talking about, how long does it take to get started in a partnership with Allianz if somebody was looking to do that?
So it is, it can be a fairly quick process. It's going to depend on the scope of what we're looking to do and what we're looking to cover, and what the goals are. But, usually to get the risk data back only takes me a matter of, a day or two. Then to kind of structure a policy, it can take a little bit longer, but usually, a week, 2 weeks, we can get something thrown together. It's typically a lot quicker than traditional financing type situations. So
definitely sounds like it.
Yeah.
Dan, this question came through for you. So in the recession kind of thing, it appears jobs are plentiful right now, but there's not enough qualified candidates. Does that have anything to do with the recession?
I don't think so. I think what has happened is we haven't gotten the participation back up in the economy. We think we lost 2 to 3 million people due to retirement from COVID.
Oh.
So we still don't have as many people working relative to the population that we should or did before. Plus, in that time period, technology keeps advancing and our workforce keeps aging. So it can be hard to really keep up with the new skills that are being, that employees want. So I don't think that necessarily plays into our concern about an upcoming slowdown per se.
That's good information. We've noticed that at other events and conferences. It is an aging market that we're currently in, and getting those younger people into the industry seems to be tough, like you said, with those new requirements that are needed and skills that are needed. We do have a couple other questions. We'll make this quick because I know we're going over time. Why did the Federal Reserve wait so long to raise the interest rates?
Okay, so the central banks like to have a little bit of inflation because, if they need to lower interest rates, they need to have a little room to do that. And they like to stay away from zero or negative inflation, which means where monetary policy is ineffective. Central banks couldn't get to that pad of 2%. So what they said was, okay, we're going to do things differently. What we used to do, they all did this, was when inflation's coming, which we don't like, we're going to raise rates to slow inflation. This time they're saying, we're going to take a different approach because that's not working. If inflation starts rising rapidly above 2%, we're going to let it go above 2%. and we might let it go for a while above 2%. Well, that's with this new policy, inflation targeting. It didn't work. They got caught with inflation was rising so fast that this new plan just couldn't keep up.
Yeah.
So, if you're the Fed or a central bank, you can't be in the middle of a big change in the economy and say, well, the plan we had, it doesn't work. So we're going to go back to the old plan. It's a bank needs credibility, and that would ruin credibility.
That'd be helpful. So what do you expect to happen in the stock market?
Well, I don't know. And neither does anybody else. And what I mean by this is I spent 3 years in investment research, and I've learned that all these companies keep saying how deep their research is, or how careful, how insightful. That's great, and I think it's mostly nonsense, because you can't pick stocks, basically. Every mutual fund managers who have many more tools than you do and have all these assistants in research can't, on the average in the long term, beat the market. Mm-hmm. They can't beat the market. So neither are you. So you
That's
have
not
to
good news.
Well, no, it leads to the correct strategy, which is to buy an index like the S&P 500 or a NASDAQ technology fund. Don't try to pick individual stocks. The second part of this is you can't time the market. You can't figure out when is the best time to go in or get out. And here's what I mean. This study has been done twice over a 20-year period of the S&P 500. It turns out that the biggest returns come in just a handful of days. So over that 20-year period of every day, if you miss the best 10 days, your return over 20 years gets cut in half.
Wow.
So if you think you're clever enough to know which days to be in and out, that would be pretty good. What most investors will do is make the classic mistake of selling at the bottom and buying at the top. So you can't figure market timing. You've got to be in it for the long haul.
Sometimes that's hard to do.
Yes, it is.
Well, I know we're short on time, so I just want to say thank you very much to Dan and Jenna. You guys provided some great information, and I know that people definitely enjoyed hearing about it and hopefully learn more from that. Just so everybody knows, we are going to put this recording together, and Dan and Jenna are going to send over a PowerPoint of their presentation that I will send out to you, as well as the recording. And thank you again, everybody, for joining us. If you haven't already, follow Handle on LinkedIn, and you will see all the other webinars coming up, as well as events. Thanks again, Dan and Jenna.
Thank you. Bye-bye.
Thank you.
Thanks, everybody.
Bye-bye.